Good morning, everybody. It is 9:30 p.m. EST 2025. Um, and today I'm going to be covering continuation entries. I do want to say today is Veterans Day, so again, happy Veterans Day to all the veterans we have out there in the server. I know we have a few here in the server with us, or any family members. Thank you for your service. In today's video, I'm going to be covering everything up and down from continuation entries. All right. This is something that I see a lot of members struggle with. They think that it's the end all be all when it comes to their trading. And I'm going to be helping you guys out with this because I feel as if the stigma of continuation entries are worse than reversal entries needs to be obliterated. Um, you guys can definitely trade continuation entries. Your approach will be a little bit different, but fundamentally, it is pretty similar to just taking overall reversal entries. Okay, I got requested by a few people to make a video of this or of this topic, so I'm here with it. Hope you guys enjoy. All right. So a few foundational information and concepts that need to be fully grasped before watching this lesson. First of all, basic structure. This is a very, very, very important component of this lesson. If you struggle understanding market structure, I advise you to go ahead and maybe watch an ICT primer video on it, or maybe a T Trades or AM Trades video on basic market structure. We also have a few videos on structure ourselves here in the WAP, and as well in the Discord in written channels as well. You also have true opens that are also fundamental in this video as well. If you don't understand true opens, again, go to the WAP, watch a true opens video, ask questions if need be, and then revisit this video when you fully understand it. Key openings, and of course, draw on liquidity. Now, key openings is going to be mentioned. A lot of this stuff, most of you guys who see the first four bullet points, the first four concepts that need to be grasped, you can already understand where I'm going with this video and already see what I'm more likely going to indirectly mention in this video. So it involves ranges. So if you guys know for a fact, or if you guys have been in the server for a while, you know exactly what I'm going to get into in the next upcoming few seconds, all right? So how to catch continuations, right? The foundational information of continuations and how to catch them, right? So continuations fundamentally tend to be the downfall for traders, but why is that, right? Many people like to go ahead and catch reversals instead of continuations. And to be honest with you, I blame the stigma behind continuations on social media. A lot of people think that bottom ticking or top ticking is better than catching continuations until you are 8-10 trades deep or 8-10 losses deep into catching a reversal, and you're down half your funded account, or you've blown through your combine or your fundeds. So again, simply by just following a continuation model, you could have easily caught a move back up or move back down instead of trying to catch a rocket ship or trying to quote unquote wait the discount. All right. Now, for continuations, the key problem or the key aspect that you guys need to go ahead and grasp, and what it tends to be, I would say, majority of the downfall for most of you guys, is understanding premium and discount. And that is easier said than done. Premium and discount is a basic concept that ICT's introduced to all of you guys, right? You guys should have an understanding of premium and discount. We have a bunch of videos that cover that in the WAP. We have pretty much, at least most of my videos incorporate premium and discount in some type of form or way. If you don't understand premium and discount, catching continuations, or let alone even reversals, it's just going to be a problem. Why? Because premium and discount is going to indicate when longs or when shorts are more likely going to be predominant in the marketplace. You have to have an understanding of premium and discount to catch high probability trades. If you don't go ahead and use it, and you're not rooted in your foundation of premium and discount, your draw liquidity would probably be fucked over. Now, if you have an understanding of premium and discount and understanding of market structure, your overall draw liquidity should be pretty obvious, all right? Now, the importance of premium and discount. The trader's understanding of premium and discount of the range skews the narrative that the trader has, right? So a lot of you guys with your misconception of premium and discount ends up altering your mindset when it comes to taking trades, right? I actually had this problem with a member here in the server once who called me saying, "Halo, I'm struggling taking continuation trades or trades in general because I would have an analysis going into the market and I want to see price drop and go into discount. And once price drops and goes into discount, I freeze and I struggle to go ahead and click the buy button." Too many of you guys see moves in the market and think that a retracement at discount is a reversal. Understand that in bullish market conditions, if you're looking for a reversal, most of the time your quote unquote reversal that you're looking for should be caught on the move up, on the higher high being created, not the higher low. So a lot of you guys, if you just switch your mindset and switch the way you're approaching catching trades, will just assist you in your overall analysis and understanding of reversals or potentially continuations. So I'm going to give this example. Let's say you're bullish and market structures, or we have market open and it's opening in the upper echelon of the daily range. If you're looking for shorts, ideally the first move at market open, you'd want to be a push up higher, not lower, right? Why? Because if we're opening up in the upper premium or the upper echelon of the daily dealing range, a move back down lower is not confirmed yet to be a reversal. It might just be a higher low being created to then go ahead and initiate a higher high later after. All right. If price distributes, most traders will look to fade it to catch a move down and not understand that price will not be seeking the opposing targets until its other target has been met. So what do I mean by that? A lot of you guys think higher high, okay, I want to catch now a lower low. And you think that the second price retracts downwards and is approaching equilibrium, we're going to blow past equilibrium and just go right down to the low. That makes no sense. Okay, bullish market structure will tend to keep on being bullish until we break that structure, right? Or until the time aligns, right? The key openings align to then proceed to allow price to maneuver down lower later on in the day, right? This thought process comes from shorting in premium and longing in discount, right? So a lot of people, we open high up in premium. They say, okay, I'm gonna wait for price to come down at discount and then I'm gonna short or then I'm gonna long this shit. And they don't do it. Why? Because they're hesitant of their own trades. And again, I'm here to resolve that problem. Okay. So understanding structure. This is going to be the bulk of the video right here. There's not an image because I want you guys to focus primarily on just understanding structure alone. Once you fully grasp what I'm mentioning in this section right here of the video, this should go ahead and cure some type of misconception you have within your understanding of price and delivery. All right. So continuation entries are supported by underlying market structure. Not every pullback means that we're reversing. The closer we get to the draw on liquidity, the more likely we are to reverse. This is a conception that a lot of you guys have to engrave in your head. A lot of you, I see FOMO because you're down 2 L's on the day, you're down maybe 2R, prices 10 points away from buy side, you're like, fuck it. I'm going to go ahead and go 5 NQ deep to then this buy side level. And then price retracts 20 points, pulls back down, sweeps the internal low, and then you're stopped out. That's exactly what I mean by price. The closer it gets to its draw on liquidity, the more likely we are to reverse. That's simply off of the logic of premium and discount and approaching the day and approaching that draw on liquidity as if you were wrong, right? So if you approach your draw on liquidity, again, this is going to be kind of hard to understand because you guys might think I'm a schizo or something, but if you approach in terms of narrative that your draw on liquidity is wrong, the higher you get or the closer you get to your draw on liquidity, the more likely we are to reverse back down. So let's say we have an overall dealing range, right? And price is coming back up into the upper echelon of that dealing range, not yet mitigating the high, simply off of the PDRA matrix, equilibrium mitigation, breaker, liquidity void, fair value gap, order block, rejection block, and then old high. You have all those PDRAs that are accumulating within that range. The higher up we go, the more premium we are. And if we're truly bearish, the higher premium we go, we're more likely to go ahead and reverse back down and start crashing lower. So that simple logic of the closer you are to your draw on liquidity, the more likely you are to reverse, should immediately push you away from FOMOing into any trade you possibly may have, right? So that in itself should assist, I would say, 99% of it, right? This in itself is a logic you should be taking each and every day into the market, understanding that price does not need to seek old highs and old lows to continue forth to its intended target, but instead will seek intermediate term lows within its range to reference later on for continuations. And the reason why I mention this is because with recent delivery, we've been seeing this occur more often than not. I feel as if it's just the right time to go ahead and make this video and present it to you guys and show you how to catch these continuation trades, right? Higher time frame with lower time frame structure is crucial. What may seem like a reversal on the lower time frame may truly just be a intermediate term low being, or intermediate term higher low being targeted to then continue to its higher time frame objective. Hence the reinforcement of straying away from the lower time frame as much as possible until it is time to enter. I don't want you guys to be staying on the 1 minute time frame when you're looking for a trade. The 1 minute time frame should be only used for either lower time frame understanding of market structure and then entries. All right, if you already have an understanding of higher time frame market structure and you want your lower time frame to reinforce that higher time frame, you can obviously do so, but do not stay on that lower time frame. All right, and it doesn't matter how low you go, 15 second, 5 second, it all systematically is the same shit, right? Now, of course, the lower you go, the lower probability you're gonna have if you don't have any higher time frame structure supporting that lower time frame structure, right? It's it's like a pyramid. The foundational information builds up on it to all the way to the peak, which is going to be your lower time frame entry, right? So what should validate continuations, right? This is going to be the answer to your problem. When looking for continuation entries, there will be an intermediate term higher low that will be referenced within an initial expansion range, which would then validate price continuing lower or higher. You can short if there is bullish sequential SMT. If you guys know what this image is right here, this price action is from last Thursday, in which we had daily cycle sequential SMT at the lows. Now, daily cycle sequential SMT at the lows, people saw that, said, oh, I'm bullish, I want to see previous day high get mitigated. What they failed to realize is that at these highs, we had 90-minute cycle sequential SMT. We then create an initial expansion range. This initial expansion range gives you the range you're going to reference, right? Then you have your intermediate term low, then you have your intermediate term high. There is a Kraken correlation with the intermediate term low to then push up into the intermediate term high that's in premium of the range. Of course, our refined range, if you guys know what that is, you know what it is. And then allows price to then come back down lower and seek lower price action, all right? So I'm going to go over this in the next slide, but the biggest misconception, and I want to make this very clear, the biggest misconception that many of you guys have in terms of trading and cracks and correlations is that there needs to be a crack and correlation in every single leg of price, and that is an incorrect statement. Notice how the crack and correlation for this range was created in previous day PM session. We then created our refined range. If you guys know, you know. We then create an intermediate term low right here. We then create daily cycle on that intermediate term low. Price then creates daily, initiates a bullish distribution, and then comes up into the intermediate term high that then taps into the premium or OTE of that refined range and allows price to sell off back down to sell side. There is no Kraken correlation at these highs. There's no weekly cycle. There's no daily cycle at these highs created with previous day or previous quarter. None of that is being initiated within this range. What is being initiated, though, is simply just market structure taking place. Now, why can you short if there is a bullish sequential SMT? When you have daily cycle sequential SMT and you're looking for continuation on already bearish market structure, bullish sequential will simply just be used as a reference point to then engineer liquidity, initiate a retracement back up into premium of the range to then target either a higher time frame, time-based POI, true open, NWOG, NDOGs, all that stuffs, or it will target an intermediate term high to then mitigate it and then make a move lower after that, right? So of course we mitigate the intermediate term high. We don't drop immediately. Why is that? YM didn't take it out. When YM took it out on this down close candle right here, we sold off and died immediately, right? There was no need for price to seek higher after sweeping that internal range high. Again, so many of you guys were looking for either continuation long up, right? Or looking for micro or 90-minute at these highs, not understanding that we did not need that sequential, or 90-minute at the highs, Now understand that we didn't need the 90 or the daily cycle at the highs to validate a move lower. Okay, you're following market structure. The cracks and correlations will be created on the initial expansion range, as I referenced in this first bullet point. Right now, an example. Right, again, this image is going to go, or it's going to be refined better off in the next slide. But again, I had to throw it in here to give you guys an overall idea of how this works. Your initial expansion will create your range. Now, I bolded the word range because most of you guys know what I'm talking about when I mean range. Ideally supported, ideally, because it wouldn't be the range you're looking for if it doesn't have sequential SMT. It'll be ideally supported by sequential SMT. All right. Your continuation entries will best appear by mitigating premium of that range alongside a time-based POI or the high or low of that range, creating a two-stage Kraken correlation, potentially a double or a double stage of sequential SMT, right? Back-to-back micro or such. Now, again, there's a commonality in between what I'm mentioning here. Intermediate term low gets mitigated here in this down close candle. Intermediate term high gets mitigated here, and then we drop. All right. When you're looking for continuation entries, there's two things you need to prioritize, right? Your overall draw liquidity, right? Your narrative of where you want to see price obtain, and current market structure. All right. Intermediate term lows and highs will be referenced to then go ahead and cause price to continue lower. This is the common misconception that people have, is that, oh, CISD, we have microcycle CISD entry at 930 something. I'm going to take this short down to sell side and then have my stops at the high. You would have been fucked. Now, why does this happen? Know that each sequential SMT that's provided will validate a certain time period or a window of distribution, right? If you have your draw liquidity being lower price action, right, and you want your range to form first, what's more likely to form? Your range or the distribution? First, your range. So when does that range hit terminus, right? If you haven't already seen the time frame alignment videos, I recommend watching those videos and understanding what I mean by range being, terminated, right? So microcycle sequential SMT would validate a 15-minute range being created. In this case, the 930 range. 945 will probably host your continuation if need be, right? So again, pretty simple stuff. Now, here's the prior image with a certain range graphed out into it. All right. Microcycle sequential SMT at the highest Q1, Q2. With microcycle sequential SMT at the highest Q1, Q2, you then validate a 15-minute range being created, this being the 930 opening range. Now, when does price deliver? Right, 930 opens, we come up, accumulate, make a move down, come back up into the range, drop. This is the low of the range. 945 is right here. And then once we have the opening of this new 15-minute range, we pump up, take out an intermediate term high that's within the 15-minute candle's range, the prior 15-minute candle's range, and then drop back down, right? This candle up here, this bullish up close candle, ended up mitigating OTE of the ES range, right? If you guys have been here long enough or have heard me mention the word fractal, this is exactly what I'm mentioning in the fucking recaps, reviews, all that stuff, right? This is recorded, by the way, so don't worry. And here's another example of that exact same methodology being instilled in the marketplace, right? Here's a continuation methodology that you guys may or may not know, right? 90-minute sequential SMT at the highs. With 90-minute sequential SMT at the highs, you then have price distribute down. Now, you have price distribute down. Where is that leg that you're going to be looking for? You guys see that there's weekly cycle and daily cycle at the lows. You think, oh shit, we have weekly cycle and daily cycle at the lows. We're going to come and make a move back up. No, price is not yet done distributing lower. And as I mentioned before, with your intermediate term lows and highs, you're going to be utilizing that to go ahead and reference what you want to see price do. So in this case, 90-minute cycle sequential SMT, then you have a refined range in this area right here. Price comes up, forms an intermediate term high within that range, comes down, targets previous day's low, creates a Kraken correlation with that low as well, comes back up into that intermediate term high after taking out the intermediate term low, and then host a distribution lower. And that would look like this on the higher time frame. So for you guys who are confused, that's what that looks like. And as you can see, I'm not pulling out the entire range. I'm simply pulling out the refine range from 3 to 345, or the 3 p.m. candles range supported by 90-minute cycle sequential SMT. If you're still confused on what I'm talking about, I really suggest tuning in this weekend for the fractal video or watching the time frame alignment video in which I discuss why I utilize these alignments, right? They're not any crazy alignments. They're simply the ones that they gave and then the one that ICT gave, right? Nothing insane. So what does price do? We have an unsealed range at the lows. Price comes down, mitigates the external low right here, taking out an intermediate term low, then mitigating the intermediate term high that's within the optimal trade entry of that refined range. Then you have price host its delivery back down to sell side, causing a sell-off all of Friday, right? So pretty simple stuff. Okay, now same shit yesterday. What does price do? If you graph out the entire leg that we had, right, from yesterday, what was the purpose of the 930 push up higher? To go ahead and create, or not line up, but to cause the intermediate term low that was created here in Monday, London, to be in discount, right? Because if we were to drop at market open, right, let's say we were to drop at market open instead of pump. So the high of the previous 4-hour candle was there. Still, it stayed there, right? There was no discounted lows. There's no discounted intermediate term lows that we can reference in price to then later host a continuation. Remember that the draw liquidity is higher, right? So price does what? Pumps up at 930, creates a distribution enough to where the intermediate terminal that's created during London session that's under true day open aligns in discount of the overall daily dealing range. And then what do you have? Intermediate term high, it gets mitigated. Intermediate term low gets mitigated, continuation back up to buy side, right? It's fairly simple stuff, all right? It's nothing too crazy. Now, you can refine that even lower on the lower time frame if you would like. You go on the 1-minute time frame. You do the exact same shit over and over again, right? We had microcycle at the lows Q2, Q3, which would then give you your refined range of your 945, fractal. And then what do you have? Intermediate term low, intermediate term high, intermediate term low into the fractal range, take out the intermediate term high, and then see price come back down to then create that higher time frame, intermediate term high, intermediate term low, soup to then continue up higher, right? Fairly simple shit. It's nothing crazy that you guys have not seen yet. It's simple ICT mixed with what we've taught in the Discord, including true opens, fractals, and time-based POIs and market structure, right? So that concludes the overall lesson in itself. I'm going to end the recording, and all the questions you guys may possibly have will be asked right now in the live section, in which I won't record that because it's just going to go ahead and be too long. Hope you guys enjoyed, and I'll see you guys later.